Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and today we're getting an update from Erik Wetterling, also known as the Hedgeless Horseman. We'll put a link to the Hedgeless Horseman down below so you can follow along with Erik's work. Erik, always great getting you on the show just to get your thoughts on investing in the junior resource sector. We were talking off mic just about the divergence between how well the gold producers have done and some of the big names and widely followed names, and even some of the widely followed development stories, but then still compared to the juniors, and also how different the gold juniors have done compared to, let's say, some of the silver stocks. And it seems like the gold and silver stocks trade when silver moves way more than when gold moves. Gold's been up at all-time highs for a long time. The stocks didn't always respond, but if silver's responding and the silver stocks responding, then some of the gold juniors start to move, but you still see more opportunity in the gold side of the equation than the silver side of the equation. And you still think there's some names that have been in momentum that could stand momentum. So I guess give us a big picture sense of how you're looking at the junior gold sector.
Yeah, I still think that this is very much a stock pickers market. We have seen, if you measure from the absolute low, some of these juniors are up quite a bit, but it's like that necessarily doesn't mean they're overvalued. I look at the current price versus current value and probable and potential future value, and as I've seen people frustratingly pointing out, is like, well, the enthusiasm for silver or lack of enthusiasm for the silver price is dictating the trading across the board kind of in the junior space. Gold juniors move more almost based on what silver is doing than what gold is doing. So it's like one could look at that and be frustrated. It's like, well, I'm in gold. Gold is at all-time highs. The gold producers have record margins, and the senior producers and the one where institutional investors can, where they tend to play, they're getting credit for their reality, which is that gold is at $2,900. But many of the juniors, they don't get that credit. And sure, in some ways, maybe not all should get that credit because, well, they're not in production yet, for example. But I would say that there's obviously, some of the gold developers are just crazy undervalued relative to the spot gold price. And some of them is like, well, this can probably become a mine. And if the gold price stays here, somebody is going to fork up the cash to actually buy that because, there's a lack of projects out there. But then you also have some of the gold junior producers who are making cash hand over fist, something I've pretty much never seen. Some are talking about dividends and stuff. So it's like, I like the saying, and I've probably said it before, you can ignore reality, but you can't ignore the effects of ignoring reality. So meaning it's like, yes, gold junior producers, they're not getting much love because silver is, shopping around. But it's like the reality is that gold is at 2,900, and some of these juniors are making such bank that's like, I looked at some projections for a couple of companies, analyst projections, where they're showing like an EV/EBITDA multiple of 2 for this year or next year. I have never seen that in my life. And it's not like they're low margin or something like that. Yes, gold could obviously go down from here, etc. But it's not like worst case scenario, gold drops $300 and it's like every junior is close to going bankrupt that's producing gold. No, there's a huge margin. Some of them have $1,000 in all-in sustaining costs, etc. So it's like I do think there was only for a short period of time where I thought that silver juniors were actually cheap also relative to gold juniors, or fairly cheap, or like fair value relative to gold juniors. But now I think, again, with the ramp in the gold price, which has done a lot better than the silver price, I think again that the gap has kind of widened where you get more margin of safety, more bang for the buck, bigger NPVs, bigger discounts in the gold juniors than the silver juniors.
Yeah, it's interesting. Some of the gold producers, the smaller ones, just haven't responded as much as the mid-tiers and the majors. And I've noticed that even we were talking off mic, a lot of Aussie stocks, I checked 4 or 5 different ones that are down recently over the last year or so when we've had record high gold prices, even in the Australian dollar. So it's really strange to see companies with exposure to gold trading like silver stocks. And with the spread between the margin reality and what they're going to be putting out for numbers for Q1, Q2, Q3 of this year, if the gold prices stay elevated, some of those producers could really run. But I want to focus in on the developers that you brought up. There's a lot of development stocks that just have a lot of ounces in the ground and they're not moving. Do you have a preference as far as where they're at in the cycle? Like, do you want them to be permitted? Is there a certain stage of economics that you want to see? Do you want them to be at the build phase or within a certain time frame of the build phase? How do you look at the developer companies that are attractive to you?
That's very much a case by case basis. But back to the earlier point about the Aussie producers are cheap and some of the juniors in the Canadian sector is cheap or Canadian market is cheap. I mean, that kind of also goes to show, coupled with the reaction to the silver price instead of the gold price. It's like we complain, or I complain a lot about crypto, for example, but it's like most people treat these gold juniors as, or any junior, as a trading sardine. It's like we can tell, it's like there's never been more value in a sense than there is now in some of these junior producers and junior developers, etc. And yet they're trading at this level. What does that say? There's like, well, there's not that much in terms of value investing going on, I think. And at face value, anything that's super cheap on paper, unless nothing forces that price to value gap to matters, like for reality to set in. I mean, theoretically, they can be cheap forever. So it's like, from that perspective, yes, you can ignore, for example, that, oh, this product is worth 20 times what the market cap is right now in a, let's say, a gold developer. But like, if there's no immediate threat, or you don't see how any gold miner would like to buy it, even though there's very much a lack of good projects, especially in the tier one jurisdictions, then I mean, theoretically, that could be cheap forever if it's considered a trading sardine, because it's not like they can punish the market. It's like, oh, it has a PE of 1. So if the market ignores it, you can have a 50% dividend yield for 15 years or something. I mean, then you're really abusing the fact that the market is treating it as a trading sardine, even though they have a good cash flowing business underneath that's just dirt cheap. So I think, I mean, preferably you would want some kind of, view that, hey, this can get monetized. Either the team, or mind builders, let's say, and they have the backing, or it's like they're waiting to get the permit on board, because that seems to also be the kind of the biggest risk in a sense. I mean, again, who cares if the gold price is at $2,900 now, if you have a project that's never going to get permitted or might be permitted in 15 years or something. I mean, if you discount that cash flow 15 years from now, there's not much left. So then in de facto, it kind of becomes a trading sardine and you're waiting for somebody to just pay up for it. So I would like to see some potential, at least, for forcing out and, putting a spotlight, let's say, on the discrepancy. And we can see that, again, that's why I kind of like some of the, junior producers, for example, because it doesn't matter what the market thinks, really. I mean, the margins are the margins, the projects are the projects. If you find something that's super cheap and they have good cash flow and they have some more projects so they can sell funds. So it's like fast forward 3 or 4 years, they might have 2 mines up and running. And if the gold price stays here, I mean, the current market cap is what they might do in cash flow per year. So it's like, is that going to have an effect on your investment? Is that going to be allowed to trade at the same price as today if they put out like future dividend yields of 30% relative to the day's price? No, I don't think so.
Well, Erik, when you think about the different flavors of development stage projects in companies, there's kind of 3 that come to my mind right away. There's a lot of nuance here, but there's small companies with production that have a big development project. There's single asset developers that have one big project and it's pretty advanced, but they are not doing anything with it. And then there's single asset developers that's pretty advanced, but they also have alpha in that they're drilling something or they're doing some kind of value creation, some kind of active work program. So between the developer that's stuffed inside of a small producer, the developer that's sitting there as a beta play, or the developer that's an alpha play, do you have a preference in those 3 flavors?
Yeah, I mean, the market tends to focus on one thing at any point in time. I mean, one I really like, which is no secret, is Integra, for example. They are a producer, they have cash flow, and it's like the market seems to be kind of totally discounting their development assets. Okay, theoretically, if they can't do anything with those projects, the market can just ignore the fact that they have two development stage projects. I mean, that's why the Lundins, as soon as they have two standalone projects, and if they're not, in the habit of like NGX and Philo, I mean, those were not going to become a cash flowing business, whereas like the market can focus on cash flow, for example, then it matters, because if you add 2 or 3 projects that the market has been ignoring that shows up in the cash flow statement, then you're unlocking the fact that you indeed have, let's say, 3 months up and running. So I really like those ones where it's like you can tell that, okay, the market is ignoring it, and you can see also the punishment for the market of ignoring it, in a sense that, okay, if this plays out and they indeed get these peripheral assets in the pipeline, they get cash flowing, even if the market does focus on one thing, which with the producer is typically cash flow, those assets are going to get monetized, or you expect them to get monetized, and then they will show up on the cash flow row. So all of a sudden, then it's going to matter. So in that sense, there I see some, real arbitrage, basically where you can abuse or take advantage of the fact that the market can only typically focus on one project, one mine, one flagship project, or again, in the case of producers, I guess it is the free cash flow, etc. But if you see waves where it's like what the market cares about or doesn't care about, if they're forced to care about it in the future, that's basically where the opportunity is. Whereas like if a junior has no way of punishing the market or making the ignorance of some of the assets actually matter in real life, then it's tough.
Yeah, I hear you on that, Eric. But as far as the developers that are sitting there as just a pure beta play, not spending a lot of money, not doing a lot of G&A, but they've got ounces defined in the ground from prior year's work program, that could go up or down based on the metals price, but the ounces in the ground are still getting valued at a silly level. So some people think that's a good quote unquote optionality play. But then there is companies that have large ounces in the ground, but they're still active. They're still drilling. They're still doing a lot of work to find new areas, or they're trying to bring in satellite pits, or they're trying to do a pit pushback or do underground drilling and, find a whole new area. So do you like between those, the beta or the alpha betas? Is there a preference you have on those as far as where you'd be positioning now?
Yeah, I absolutely prefer the hybrid plays where there's beta and alpha, because obviously if you have enough alpha, that can put the increase the threshold, let's say, for the project, where it's like it started off as a tier 3 optionality play, and they find something, a satellite deposit or something, all of a sudden it gets hiked up to a tier 2 asset, and all of a sudden it's like, oh, some mid-tier has to basically buy this. So you get paid to, you get the beta anyway, and yes, there might be increased dilution in a sense because they're actually doing work, but then there's also the potential for the project to hit a new threshold or a new tier, let's say. So you kind of get paid to wait, whereas the mature project, it's purely a beta play, and you're just waiting. It's like, obviously they have G&A and all that, so they're forced to dilute, and it's more of a option basically, but there is some cost to it via dilution, but some of them are just crazy in terms of how cheap they are. So it's like I think there's many ways to skin the cat, and I wouldn't be against any one of them, but at least you, as an investor, you have to be prepared. It's like, what is the play? If you're in a pure beta trading sardine in a sense, then you should be aware of the fact that this might be super, super boring and might be some additional dilution until whatever silver price goes up, that takes the gold juniors higher. And all of a sudden you go from like, a flat line for 1-2 years, poof, all of a sudden it's up 400% in 6 months or something. So it's like, what suits everyone is what they should be doing. I much more prefer the latter ones you mentioned, the hybrid plays, that have can change their own destinies in a sense.
Yeah, it makes sense because the alpha plays still have more news flow as well, and it keeps investors engaged, keeps more volume in the stock. So a lot of advantages to having a little alpha along with the beta. But eventually, all of these things, even the beta plays, the trading sardines, as you call them, will eventually get their day in the sun when things get re-rated higher. But I think some interesting opportunities you point out in some of the small producers or the small producer developers that have a mix of projects. So definitely a lot to keep on the radar and keep following along with. Hopefully silver does good, so the gold stocks do good. But thanks for coming on the show as always, Erik. And if people listening in want to follow along with Erik's work, definitely click on the link below this interview. It takes you over to the Hedgeless Horseman website, where you can follow along with the companies that Erik's writing up, some of the news flow in those companies, and also some of the videos that he does over at YouTube, where he walks you through his investing thesis and the way he looks at the markets. As always, Erik, looking forward to our next conversation.
Thanks, Chad. And assume I'm biased. I own Integra in this case, and they're also a banner sponsor. So twice